Hello, thank you for joining us on Minds of Commercial Real Estate. Today we have Douglas Ruark. He is the founder and president of Red Rock Securities Law. Douglas, thank you for being on the show.
Oh, pleasure, and thank you.
You got what I want, got what I want. You give me just one look and you know I'm good to go. You know I'm good to go.
Today we're going to discuss, how let's say on the commercial real estate side, people are looking for equity and, and they're short in order to get a loan, or they just want all equity, and how we can raise money for them. And Douglas is going to, give us three different main ways, and we're going to go through a little bit of the examples of each.
Yeah, absolutely. So, when you're looking at syndicating capital for real estate, and you're going to go out and raise money from investors, really kind of puts you into our wheelhouse here as far as our law firm and the securities work that we do, because we set up SEC securities offerings, and about 50% of our work is for the real estate community. And there's essentially three options that can be deployed as far as the programs that the client may file under to sell securities, whether those are equity securities or whether they're debt securities. And the first option would be Regulation D. So Regulation D is the what I call the traditional security sales exemption, meaning if you had an LLC and that LLC is going to purchase a self-storage property and you're required to bring $3 million in equity to the table, and let's say the sponsor is going to go raise that capital from investors, that Regulation D would be an option. It's in essence, you're going to be selling those membership interests. Those are securities, so there are rules that apply to that. And so Regulation D would kind of be what I'll call the first option, and what I like to call the simplistic option. Regulation D has been available since 1982. It's gone through a lot of different changes and upgrades. There's programs that have come in, there's programs that have left under that umbrella. And the benefits of a Reg D offering would be primarily it's going to have the lowest legal cost to prep it. It's going to have the shortest time frame to prep it. It's also going to have the least amount of compliance associated with it. And there's essentially two primary programs under Reg D that most people would avail themselves of. The first is 506B. Now, that is what I call old school kind of traditional private placement program. You're not allowed to generally solicit anyone with that type of offering. So typically it's going to be to friends, family, known associates, people you have sub-sib relationships with. And usually if we're setting up that type of offering, it's what I would call a pre-syndicated deal. Client says, hey, Doug, I've got 15 people lined up to contribute the equity. I'm selling a membership interest, so I need some legal work done and some SEC filing work done. But ultimately, I'm not going into the public with this raise. And that's where a 506B would be great, because ultimately it's going to provide that proper legal vehicle to provide full disclosure, provide all the appropriate documents, subscription documents, private placement memorandum documents, so that the investors can get full disclosure. And then if they want to purchase those membership interests, they can purchase them. The other program is 506C. Now, 506C came out under the Jobs Act of 2012. And 506C, the big draw with that one is you are allowed to generally solicit the public with the offering, but you are limited to accredited investors only. Now, in general, an accredited investor is going to be someone that makes $200,000 a year in income, $300,000 if they're investing joint with their spouse, or they have $1 million net worth, and that's exclusive of any positive equity value in their primary residence. So the 506Cs are popular because for a lot of these sponsors and syndicators, they are looking to get into the public domain to raise money. So they are looking to get out on their LinkedIn, their Facebook, they're doing press releases, they're doing webinars, come invest with us. And 506C obviously allows them to get that exposure, albeit it's going to be accredited investors participating. And I think with the Reg Ds, what I get my clients to look at is if you're interested in having a cap table that's mainly going to be minimum subscription amount of $50,000 and up, then the other two options that would be available, which I'll describe in a second, the primary advantages of those is bringing in money from non-accrediteds. But if you're at a $50,000 min subscription, you're probably going to be eliminating most non-accrediteds anyways. So with the Reg D approach, again, it would provide that proper vehicle to go out, syndicate capital, and be able to do so in a very straightforward, streamlined manner, low legal costs, short time frame to prep it, no SEC approvals. In fact, the main interaction with the SEC under a Reg D is going to be through a Form D notice filing, which is essentially just a filing that's letting them know we're doing a Reg D offering. Here's some basic info on the company and the raise. So we do a lot of Reg D work. It's a great program. It's a nice option to have. And like I said, the 506C program does let that client go into the public domain and raise capital. The second option that we can set up and deploy a client under is Regulation CF. Now, Regulation CF is commonly known as crowdfunding. I actually don't like using that term, Kamyar, because ultimately this is all raising money from the crowd. It just really comes down to what program have you filed under, and that's going to really drive the capabilities of what you're able to do with the offering. But with Reg CF, as some backstory on that program, that came out under the Jobs Act of 2012 as well, just like 506C did. But it was originally limited to $1 million in annual period, and you had to launch and execute the raise on an SEC-approved crowdfunding platform. Now, there's some downsides to those platforms. They've become pretty expensive. I mean, a lot of them are charging 8% commissions. They want equity in the deal. They own and control the prospect data. So you're out on your LinkedIn, pushing your raise, and basically you're driving this prospect traffic in. Well, that's their prospects now. And the other issue is you're driving these people to a raise website, a platform that might have 100 other deals in your industry a couple clicks away. In March of 2021, the SEC made two big rule changes. The first is they opened the door to FINRA broker-dealers serving as your intermediary. So now they created a second pathway to be able to go do a Reg CF, which is if you have a broker-dealer administering the raise and you're complying with the rest of the CF rules, you have a compliant CF. They also took the limit up to 5 million. And that was impactful as well. I mean, I don't have a lot of clients that are raising under $1 million, but I do have a decent amount between 1 and 5. And a great example might be a real estate developer with an infill site development project. And ultimately they're looking to raise $3 or $4 million in equity. And Reg CF then is great because they can generally solicit the public with that offering, but now they can raise money from everybody. So with the CFs, the way we do them, it's a little bit different. We do what's called a direct issuance Reg CF, where we get the legal work done, we build the raise portal, they'll run the raise, and then we align the client with a broker-dealer to be their broker-dealer intermediary. And our broker-dealers typically charge a 3% commission. They don't take any equity in the deal, and the client gets to own and control their prospect data. And the benefit there then is we've really kind of created a little mini Reg A plus form. And Reg A is the next program I'll describe in a second. But essentially what they've got is they've got a little mini public offering as far as capabilities. They can generally solicit the public. They can be out on their LinkedIn, their Facebook, their corporate site, and they get to raise money from everybody. And I think when you look at the real estate crowd, I think that's an important piece for a lot of the real estate operators, that ultimately they are looking to build this affinity base of investors underneath them that are going to support them with capital in the future for years to come. And so ultimately then if they're able to continually raise money from more and more people and they have access to the entire public, it allows them to build that affinity base much more quickly. Reg CF is limited to 5 billion in a 12-month period. The other key note on offering amounts is that any offering over $1,235,000 requires audited financials. Now, how we handle that is the client can either just come in with the audited financials. And by the way, if it's a brand new special purpose entity to raise money to acquire an asset, for example, it's just the opening balance sheet, and that's going to be minimal cost. Or we launch them at $1,235,000 and they can kind of just see how the raise is going. And if the raise is going well and they want to go above that, then they just tap the auditor on the shoulder, get the audit done, and then we can revise that offering up to whatever's left under the 5 million max. So CF is like I said, a great kind of what I'll call middle option, which is it'll give Reg A investor acquisition capabilities without the cost, timeframe, and SEC qualification of a Reg A. And as far as Reg A, that's really kind of the third program that's available. And Reg A is kind of unique in a number of ways. Reg A, first of all, has been around for a long, long time. the original Securities Act. It got a major upgrade as well with the Jobs Act, although those rules didn't hit the Federal Register until 2015. Most people are going to file under Tier 2 Reg A. That's the program that lets you raise up to $75 million in a 12-month period. And once you're federally qualified, you can immediately go sell in all 50 states. You can also accommodate investment from international investors through a Reg A. Now, there is a Tier 1 Reg A that allows you to raise up to $20 million in a 12-month period. The difference there is that you have to go through the same federal qualification process as Tier 2. And once you're qualified with Tier 1, you then have to pick what states you want to offer and sell in and qualify at the state level. So Tier 1 has some limited applications, in my opinion, mainly meaning, if a client's really just looking to raise money in the state of Florida, for example, maybe they have a pizza shop, they got 10 locations, they want to do a Reg A and raise money for 10 more, and they're really just going to their customer base and all their customers are in Florida, maybe a Tier 1 works. So there are some applications where it may work. But in essence, most people go into Tier 2 because they want to raise that $75 million. They want to be able to generally solicit the entire public, and they want to be able to do that out of the gate, not have to worry about state qualifications. The Reg A does have a different preparation process. So it basically is an S1 we're drafting. I mean, the Form 1A follows the exact same pretty much format of an S1. So it is a more granular filing to create. It does take longer. It takes more legal work. It takes more costs. With that said, once it's built, if the client wants to raise more money in a second round, for example, then obviously a lot of the legal work's already done. There's already a 401A sitting with the SEC qualified. That's the other main difference to the other two programs is that with Reg A, that offering is going to go through an SEC qualification process. Now, if you have a firm like ours on board, we do Reg A's day in and day out. That's a pretty straightforward process, especially for real estate. But it is an extra step in the process that there is an examiner at the SEC that is going to review the file and ultimately you're going to obtain qualification on the file. The other thing that we've done with Reg A that is interesting as far as the real estate side. So we've done a lot of real estate funds under Reg A where it's just a multifamily asset fund. Like we're going to go buy self-storage properties or we're going to go buy multifamily properties. We're going to launch a Reg A and raise $50 million in equity. And we're going to have, senior financing in the cap stack. And we're going to go acquire properties with this capital. The other way that Reg A's get set up is with a series LLC structure, where there's a series LLC form, there'll be an initial asset, and there's a ground up build of a Reg A for that series. But then as the sponsor or syndicator has a second asset, now it's create just Series 2 LLC, and now we just add that as an amendment to the original Reg A filing. So now there's some cost, major cost benefits, speed benefits, because now we're not ground up building another Reg A for asset 2. We're just creating Series 2 LLC, and we're basically adding that as an amendment to the original Reg A. And where that works is, for example, a client that maybe is going to do a VRBO real estate fund, where they're going to be buying vacation assets in, Breckenridge, Colorado ski condo, or they're going to be buying a Palm Beach beach condo or what have you, where they're probably going to want to provide investment choice. Doug's in Colorado. Doug understands the Breckenridge ski market. I'm going to be interested in investing in that asset and only that asset. I'm not interested in the Palm Beach stuff or the cabin out at Min. And so that's where then we've seen a lot of those types of deals set up, where Series LLC set up for Reg A. And as that client has new assets to put in to syndicate, they're getting obviously the speed and efficiency and cost benefits, but they're also, each asset now is in its own Series LLC. So it is segregated. And most of those clients then are going to have on their website, they're going to basically have essentially a platform showing the assets they're syndicating for. So we got 10 assets we're currently syndicating. Here they are. And obviously Doug is the investor, has the ability to pick and choose what assets that he wants to invest into. So Reg A is a great program. I think for the real estate crowd, what I get them to look at is if you are going to be looking to raise capital year to year, and you want the premier vehicle, you want to be able to raise money from everybody, you want to build an affinity base quickly, Reg A is a great way to go. It does have a longer lead time initially to prep it. It's got more legal costs associated with it. But again, once it's built, it's a great vehicle as you go year to year to continue raising capital.
Got it. Thank you, Doug, for that amazing information. Of the three that you mentioned, what would you say are the pros and cons of each?
Sure. With Reg D, The pros would be shortest time frame to prep it, mainly just because it's just put your head down and get the legal work done. There's no SEC qualification. You're not dealing with audited financials and an auditor signing off on things and what have you. And simplicity as far as compliance. There's not a requirement for audited financials. You're not required to have a broker dealer run the raise. You're not required to make update filings beyond your Form D notice filing. So I would say that the pros with Reg D would be simplicity, short time frame to prep it, lowest amount of legal costs, least amount of compliance associated with it. The downsides would be that, let's say, take Reg D 506C, you are limited to accredited investors only. So if the client is really looking to access the entire investing public, they're not going to get that capability through a Reg D 506C. The other downside is that in a Reg D 506C, everybody's got to be accredited, but they have to provide verification they're accredited. Now, our technology, Raise Portal Tech, it automates that, but at the end of the day, it's still an extra step. I still need to go get if it's a third-party verification, I got to get a CPA letter or a letter from an attorney or a letter from the verification service. And that extra step is, it typically involves the investor leaving the investment process, which from a sales standpoint is not ideal. The other thing I found is it is a little bit more, there's more due diligence, a little bit bigger of a lift for a broker dealer to sell out of a Reg D, mainly because it's not as sophisticated of an offering. With Reg CF, pros would be you get Reg A investor syndication capabilities. You get to generally solicit the public. You get to raise money from everybody. You also get a broker dealer on board. That broker dealer is there to they're going to build confidence with investors. I hit the raise portal. Oh, there's a thinner broker dealer running this raise. Okay, I feel better. That broker dealer also works to get exposure. Now, they don't commit to raise capital. None of them can, but they are incentivized to see that client be successful. They're taking a commission, obviously. That's their compensation. And so ultimately, they will work to go out into their social media networks and work to get exposure for the raise. You also get a nice, clean, 3-minute investment process. And in that regard, that's one of the benefits of CF and Reg A is that there is no verification process. And so ultimately, if Doug decides to invest in a CF or Reg A, and I hit the invest button on that portal, it's 3 minutes. It's basic info on me. I type my name and hit submit to sign the subscription document. Great, Doug, how do you want to invest your 10 grand into this fund? I'm going to put it on my Visa and get some points. Great, give us your Visa number. And then everything automatically goes over to the transfer agent. There's nothing that Kamyar needs to do as the sponsor to get Doug through the process. It's so quick. I've even said that if I'm at a Starbucks and I put my coffee order in and I'm on my mobile phone and hit the invest button, I'm probably going to be through the investment process before my coffee's up. So that's a benefit to the CF is the fact that it's got that streamlined investment process. Downsides to CF. Downsides to CF. Number one, you're limited to $5 million. So for some of my clients that just can't get by with, with that type of capital, maybe they're buying a multifamily property and they need 10 million in equity. CF's just not even going to be available for them. Number two, any offering over $1,235,000 requires audited financials. Now, if it's a brand new special purpose entity for a syndication or a real estate fund, that's not going to be a big deal. That might be, through $3,000, $3,500 for an audited balance sheet. If it's a company that's been around for a while and they've got maybe some complex financials where they need 2 full years of financials audited, that could be obviously a more robust expense. And then, the other downside, and I say downside, I don't know if it's necessarily a downside, but you do have the broker-dealer commission. There is a 3% commission to the broker-dealer. Now, obviously, they're running your compliance. They're building confidence. You're selling under their license, essentially, in all 50 states. So they're bringing a lot of value to the table for that 3%. But if I've got a client that really, really has tight margins, that 3% obviously is something they have to take into account. Reg A, upsides. Most sophisticated vehicle you could launch to raise capital is going to mimic a public offering as far as investor acquisition capabilities, has a selling security holder feature, which means up to 30% of a Reg A can be people on your cap table selling their securities to new investors. That's actually a good benefit for real estate funds as they go into year 2, year 3, where maybe it was a brand new entity in year 1, they do a Reg A, they raise money, they acquire assets. Now they go into year 2. Hey, we're going to go raise more money with a Reg A in year 2. Great. let's go to Doug, who's on our cap table, who invested in year one, see if he wants to sell some fund interest and have a liquidity event. I've also found that because of the additional sophistication of Reg A and the fact that it passes an SEC qualification process, it is easier for broker-dealers to get involved in selling it. I also have found it's easier, in my opinion, for family office money to come into it for the same reason. It's a more regulated offering. The securities sold out of a Reg A are freely trading out of the gate. So ultimately, if Doug buys securities out of a Reg A and, 30 days later, he decides he wants to sell, there aren't restrictions on that they are freely trading. A lot of Reg A issuers, when they close out of their Reg A, will get up on an ATS system, an alternative trading system. And that's another avenue that would allow the investors on the cap table to have an avenue to put their securities up on that ATS and sell them. Downsides to Reg A: longer prep time frame. We're normally about 90 days to get a Form 1A and all the exhibits done, get a prep for SEC submittal. And then from there, if there's no comments, we'll typically hear back in 5 to 7 business days from the SEC, but you're probably still waiting on FINRA to clear the broker-dealer's no objection letter. So usually what I tell people is that second half of month 4 is a reasonable time frame to have a Reg A qualified, prepped, qualified, and launched. So longer prep time frame, more expense by about double. I can typically have a Reg D client out somewhere in the low 20s as far as legal work and portal build. Most of my CF clients are going to be mid 20s, and that includes broker dealer and transfer agent costs, and obviously our costs. Reg A is usually going to be more like 50 to 60. And that's really just representative of the time. It is about twice the time and effort to put that Reg A in place as far as the legal work goes. And then, ultimately you do have to maintain you have to come in with audited financials. You have to maintain audited financials going forward. Now, a lot of people would say, hey, best practices, you got a lot of people on your cap table and you run a real estate fund and you got, 400 investors. You ought to be running audit financials to protect yourself and the company anyways. There are also 2 update filings with Reg A, Form 1 SA, which is the semi-annual, and Form 1K, which is the annual. Now, they're pretty simple, pretty straightforward to put in place. They're nothing like a 10K or 10Q. We normally put those together, $5,000 for a Form 1 SA and $7,500 for a 1K. So not a massive expense there, but it is an additional expense on an annual basis that the issuer would want to factor in.
Thank you for all that great information. It's a lot to digest, but hopefully they can go through the video and pause and just, take notes. We will, do another podcast and go through each one of the 3 more in detail and with more examples. Doug, what is a good number or email of where viewers can get a hold of you?
Yeah, absolutely. Well, our website is www.redrocksecuritieslaw.com. They can call me directly on my direct line here in the office, 720-586-8616. And then my email is doug@redrocksecuritieslaw.com. And I'm more than happy to spend time with people as far as educating them on these programs. And in part, because it just is a great spot in the industry at this point. With the SEC rule changes of the last 10 to 15 years and the tech now that runs these raises, we're just in a great spot. It's a lot more efficient and effective now for a company to go out and raise capital. The fact that they can get massive amounts of exposure with these programs now, that they can generally solicit the public, is fantastic. And then it's just nice to have all these options, because I found there tends to be an option that fits what the client's needs are. Hey, Doug, I got to be out quickly. I'm fine with it just being accredited investors. I want to be super simple. I want to be out with the least amount of legal costs. Great. Let's do a Reg D. I'm raising $4 million for an infill site development project, but I want to raise money from everybody and generally solicit. Great. Let's do a Reg CF. I mean, it's just nice to have these options, and we didn't always have them. I've been doing this 25 years. I remember when we didn't have these options. And so I think it's great. It's a great spot in our industry. So I'm happy to do calls and kind of run people through where we are and the programs, and obviously the capabilities of these programs.
Again, thank you for all the information, and we will be doing one on each one very soon. Thank you, Doug, for being on the show.
Thank you. I appreciate it.
Thank you for watching. If you enjoyed this episode, please give us a thumbs up, subscribe, share any questions or comments in the comments below, and follow us on social media. I look forward to seeing you next time.
Let's get together. Let's get to having some fun. Let's do whatever. The night's together. Let's get together.